Hello everyone, welcome and thanks for watching the Market Report. I'm your host, Marcel Peschman, analyst and writer at Cointelegraph. This show debates the most pressing topics impacting the crypto market, focused on price changes and meaningful events. Today's show first article was written by Tom Mitchell. Is SBF secretly behind bald crypto Twitter debates latest conspiracy? Crypto Twitter has been abuzz with the debate after a new conspiracy theory has suggested FTX founder Sam Bankman-Fried may be secretly behind one of the most controversial new meme coins on Base. So, for those unaware, Coinbase exchange Base Network was launched on July 13, but the exchange urged ordinary users not to use the network as it lacks functioning user interface for its bridge, the connectivity with the Ethereum main chain. On July 29, a pseudonymous developer with the Twitter handle BALD announced the launch of the BALD token on Base Network. The BALD meme coin, which draws its namesake from the humorous reference to Coinbase CEO Brian Armstrong, was launched on July 30 and witnessed an incredible 289,000% gain in the first 24 hours of trading. Okay, it is impossible to know how many addresses the BALD developer was using, possibly to prop up the price and volumes on decentralized exchanges, DEX exchange. So one should not assume that those price gains were realistic in the first place. The evidence pointing to the FTX founder Sam being the masterminder of the BALD token include wallet funding from addresses associated with FTX and Alameda Research, besides the fact that the BALD developer was the first voter on the Sushi DeFi project proposals. Also, the language use of the BALD developer on his tweets, and lastly, the DYDX DeFi project farming activity, where the BALD developer held a large and active address. So here you have some of the allegations. This was posed by Hype ETH, but hundreds or dozens of analysts and investigators posted similar findings on Twitter. But you can see that includes sushi proposers, the thousands of ETH transfers between FTX and BALD, the DYDX farming activity, and their posts sound like SBF. After the token's anonymous developer removed thousands of Ethereum in liquidity, the price of BALD plummeted more than 85%, sparking allegations of a rug pull, which the developer has denied. Despite the evidence, some traders and analysts have a firm belief that FTX founder Sam was not involved with a crazy token launch, including Scott Melker. Check it in for 5 minutes, and apparently crypto Twitter believes that SBF, so Sam from FTX, rugged BALD, even though he has no internet access, computer or phone, and is under house arrest and at the risk of going to jail forever. This place is ridiculous. While I do believe that Sam is perfectly capable in terms of technical knowledge of issuing tokens and offering liquidity pools on decentralized exchanges, there's no way to know what kind of devices and internet access he currently has under house arrest. Therefore, regardless if it was Sam or some other former Alameda Research partner, investors should do further due diligence, so further analysis, before jumping into new projects, especially when there's increased risks such as less participants due to the token bridge restrictions. Wasting time to understand if a rug pull took place or who was behind it won't help you recover losses. If, unfortunately, that was your case, try to use it as a lesson not to believe in the decentralized exchange trading volumes and prices concentrated on a single pool launched by an anonymous entity. Just to highlight, that's my own opinion. It does not constitute investment advice or reflect Cointelegraph's official view. Now, on to the next topic, we'll cover an article by William Suberg. Bitcoin price raised FOMC gains as US dollar surged on second quarter GDP print. The strong economy or soft landing narrative is gaining some traction, but the Federal Reserve would still like to see softening of the labor market to support the thesis, relative to what the historical record shows about the correlation between the labor market and inflation, material indicators added. So the author is talking about the 2.4% US GDP or gross domestic product growth in the second quarter, which came above the market consensus at 2%. So a soft landing means the Federal Reserve is doing a good job on taming the inflation while avoiding a recession, which has been the case, but the analyst material indicators points to the overheated job market as the unemployment rate has been at the lowest levels of the past 40 years. Might sound like a positive indicator. The low unemployment doesn't help the Federal Reserve target to curb the inflation to 2%. Furthermore, if people are working 2 or 3 shifts, having 2 or 3 jobs, while still being unable to save money or cover their monthly bills, this is an alarming sign that the economy could soon enter a correction because the consumer demand will slow down. The article goes on to add, US dollar strength hits 2-week highs. The GDP likewise had little impact on market expectations for the Fed policy would go at the next interest rate decision in September. Odds of rates pausing at the current 5.5% stood at 76%, with a 24% likelihood of another 25 basis point hike, according to the CME Group's Fed Watch tool. So basically, the market is now betting that the Federal Reserve will hold on tight on the next meeting to monitor macroeconomic data before further tightening the economy. This is usually bullish for risk-on markets such as stocks and cryptos, given that the increased interest rate favors fixed income investments. So the longer the rate stays at 5.5%, the better for stocks and cryptos. However, the article also explained why Bitcoin has been recently under pressure and lost the $29,000 support. One conspicuous reaction, traditionally a headwind for crypto, was the US dollar's strength, which spiked on July 27. The US dollar index, DXY, hit 101.84 and it's currently at 102.20. So the highest since July 11 and furthering a bounce from its lowest levels in a year. So check out the chart of the DXY index. You can see that it reached the lowest levels in the year below 100 and has been gaining strength currently at 102. The DXY index measures the US dollar against a basket of foreign currencies, including the euro, Swiss franc, Japanese yen, and the GBP. So the higher the DXY goes, it means investors are giving a vote of confidence to the Federal Reserve. They are betting on a soft landing, so its probability has increased. This is typically interpreted as negative for Bitcoin, as investors use the cryptocurrency, so they buy Bitcoin as a hedge for hyperinflation and the devaluation of the US dollar. So when the DXY index goes up, it is usually interpreted as a negative sign for Bitcoin. This explains why Bitcoin has just lost the $29,000 support and why investors' mood isn't improving despite the possibility of the spot Bitcoin ETF approval. And the latest estimates that the US Treasury is going to have to issue debt of $1.85 trillion over the next 6 months just to cover their expenses. This might sound like a crazy amount, and believe me, it is, in the tune of $480 million per business hour. The Treasury is going to have to issue debt. So it's a crazy number, but somehow investors believe they can successfully manage it. Only time will tell. If the debt levels of the United States become ungovernable, like they're heading to $1 trillion in interest payments for the year, which is crazy, then that's going to be positive for Bitcoin, but in the medium to long term. So for now, the strong DXY index, so the dollar strength, is a negative trend for Bitcoin. It's pushing Bitcoin price below $29,000. Well, that's it for today. Hope you guys enjoyed the show. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!